The most important CPI print of your life is done, and what an actual dumpster fire. Both core and headline came in a lot hotter than expected. Stocks fell, yields rose, and with the S&P 500 breaching critical levels, we need to start talking about the inevitable pullback. Should we be buying dips, or will this pullback lead to something a lot deeper? Today, we answer that question and talk about the ramifications of high inflation, what it means for you, stocks, and the economy. We're also going to be talking about rate cut expectations and what your portfolio should look like in a stickier inflation environment. We got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. Inflation came in hot and the market sold off today, guys. I mean, pretty brutal day across the board. Red everywhere here in financials. Technology, consumer cyclicals, industrials, right? Everywhere was red. The worst sector though had to be real estate right here, okay? Anything levered to real estate just did absolutely terribly. So we did see some sectors do well. Energy caught a bid, no surprise there. A few names here in insurance. And then we saw a couple of defensive names, Eli Lilly, Walmart, Costco, Procter & Gamble, right? We also saw positive flows here in Nvidia, as well as Meta, and Amazon was pretty flat. Other than that, red across the board. Looking at sectors, energy, the only positive sector today, up 0.31%. Maybe there were some subsectors that were positive in financials like insurance, but have a look right here, guys. Home construction, real estate, and regional banks, which is pretty much commercial. Anything tied to real estate and rate cuts that were dependent on rate cuts coming in June, July, got absolutely sold off. But everything apart from XLE was down, even staples down 0.36%. XLI, semiconductors, the SPY was down a full percentage point. And the reason why, okay, we got hot inflation. Inflation was hot. That's it. There's nothing more to say about it. CPI came in at 0.4, month over month, year over year at 3.5%. We were supposed to get 0.3% and then 3.4%. On the core side, 0.4%, 3.8%. We were expecting 0.3%, 3.7%. So guys, the two components that kept this number hot was actually shelter and auto insurance. Everything else in the print actually came well within line. Sure, there was some outliers both on the upside and the downside, but yeah, auto insurance plus 22%, absolutely crazy. And then shelter, these two represent more than like 60-70% of total core inflation here. When they're elevated, you're going to get an elevated number. Now, what did this do to rate cut expectations? It did a lot. So we are now only expecting 25 basis points worth of cuts in 2024. The first cut is looking like September. And you want to know what's absolutely crazy? There's a 13% implied probability of 0 cuts in 2024. So in the December meeting, right? 13% chance of us staying at the current Fed target rate. 45% of a cut here plus 18% of a cut all the way to as low as 475 to 500 basis points. So it does look like the market expectations have officially pivoted from June, July into September right here. And that is why the market sold off. That is why real estate sold off. That is why anything levered to interest rates just got absolutely hammered, like regionals, like real estate, like home construction. And it's not a good look, but let's hop on the charts. I'll show you everything in detail. All right, couple of things. Firstly, look at all of these major indices, right? The SPX, NDX, RSP, mid caps, small caps, IWM, everything was down big today. Small size did much worse than large caps. There was a clear liquidation and just flight to quality away from high beta. Okay, we also saw growth outperform value, and we did see yields spike quite significantly. Now, these are after hours moves, but yields were up anywhere from 2 to 4%. And then we also saw stuff like oil catch a bid up 1.15%, the dollar caught a bid. Those are two things you don't really want to see, but it's what happens when we get hotter inflation data. But let's hop on the S&P 500 and have a look at everything. Now, number one, let's hop on the weekly chart and let's actually just measure, right, this move right here, the drawdown we're currently experiencing. So from peak to trough, right there to right there, 2.38%. Okay, so the market's down a full 2.4%. Wow. If you lived through all of this in 2022, 2% days were the norm. 2% days were, we got a 2% down day in 2022 and we were like, it was a good day, right? It was a good day. That's what we would tell ourselves. So we're down 2.2% in 2 to 3 weeks. It's fine. It's no issue. Now, let's look at the big picture, okay? Firstly, on the weekly chart, I am not bearish and I'm looking to buy dips all the way to pretty much this 49.88 level. It was just like where we made these lows right here. We get to that level right there, we find support, I'm a buyer. We move below that level, things can get a bit dicey, and then we go to the monthly chart to find the next level. But right now, I'm a buyer of dips. I want to find strength anywhere between right now and the 49.88 level. So, again, if we are to measure that, how much of a pullback would that be from where we are right now? Another 3.28%, and then a peak to trough, 5.11%. At this level right here on a weekly chart, that's when I really start looking at, hey, we need to find support. Bulls need to put in work, 49.88. Below that, we can then see lower levels, and we'll talk about that if we do get there and we do have price discovery, below these levels right here. But until then, let the market pull back, let the bears do their thing. And you just want to be ready with capital to buy some quality names or buy the ETFs you like. Now, looking at the daily chart, guys, things are starting to break down. So the weekly looks healthy. The daily chart, things are really starting to break down. You can start to see that we're wicking below some of the lows of last week, approaching some of these lows right here, especially if we do, fall, a couple more points down. We're looking at 20-day, 1-month lows in the S&P 500, and then things can start getting a bit frothy for the bear side, not necessarily the bull side. So a couple of things I want to note, right? This is a very, very crucial level, and we are above it right now. This marks an insanely crucial level right here. This was the employment report. So tomorrow, I think this is the level you want to look at, 5146, okay? That is the level you want to look at. If we're above this level, we find support here, we can move higher, 100%. If we're below 5146, I would look at some of these crucial levels like that and like that. We're at a very critical zone, 1546. We are above it right now. I think if we gap up tomorrow, let's say we have a very solid Asia trade, we gap up, we can then look to yesterday's lows, but anything below 5146, and I think we're going to see lower price action, something like that, all the way to 5100 levels, heading into that PPI report. That's what I'm looking at the daily chart. The thing is, on the daily chart right now, the trend is lower. We're breaking some of these key levels, and you probably just want to sit out the volatility, guys. There's going to be probably more downside if we don't hold this 5146 level. If we do hold this level into tomorrow and then catch a bid, like a lot of the bulls did coming here today, if we do hold these levels, catch a bid, okay, then we would then look to some of these levels to go and retake those highs. But I'm not even going to talk about that. Right now, the bulls just need to hold this 146 level. Otherwise, we're definitely going lower here in the S&P 500 because the daily chart's not looking that healthy at the moment. The weekly, 100% fine. We can wait for a pullback all the way to 49.88, but the daily chart looking a bit unhealthy. Let's actually hop on the 5-minute chart really, really quickly. So this is our line in the sand, right? 51.46. And today's trade, we actually saw a massive gap down after the CPI news. And then we had a very muted range, excluding the gap, not a very big range. And we just had bulls by the dips right here. We had bears coming strong. Both bulls and bears put in their work for the candles intraday, and we did close with a pretty strong wick, which is constructive for the bulls. But what they really want to do is go ahead, break these levels right here, close the gap. That's what bulls really want to do, and they want to do that before the end of the week. Otherwise, it's probably lower prices. We're looking at 2 weeks in a row now that it's going to be a pretty good week for the bears. This week is looking like it, but still a couple of days left. So guys, this is the S&P 500 and percentage of stocks at 20-day highs. And this is a really interesting chart. As you can see, normally when we get above the 55% mark, we enter what we call a 20-day breath thrust regime. We entered one right here 3 months ago. And normally when we do enter a 20-day breath thrust regime, the returns are quite spectacular. You can see 1 year later, 15.8% in the S&P 500, 96% of the time positive. Look at the risk to reward, nearly 2-to-1 risk to reward with an extremely high hit rate. That's exactly what you want to see. And at the same time, 6 months gain, 3 months later you have a gain, 1 month later you get a gain. And that's exactly what we've seen in this market. Very linear returns. And the truth of the matter is we're only 3 months into this regime. And yes, we can definitely get a pullback, and it could be upward of 10%, but you have to look at the greater context of it. We are in a 20-day breath thrust regime, and that means you want to be a buyer of dips when the market gives you those opportunities. So we've been going over earnings this past week, financial earnings ahead of a big reporting season that's kicking off this Friday. So we've looked over quite a number of these names: JP Morgan, Citigroup, and today we're going to tackle State Street as well as Wells Fargo to wrap up all of these names ahead of their earnings on Friday. Now, Wells Fargo is expected to report $20 billion worth of revenue, $1.1 in EPS. We're seeing a decline of 1.68%, 10.15% respectively. And coming off what has been a fantastic year in 2023, Wells Fargo is actually going to be decreasing their earnings quite significantly. I think a lot of this probably has to do with how their bond portfolio is currently situated. They are sitting on a lot of unrealized losses. And I think what you'd really want to do is break down the unadjusted GAAP numbers for Wells Fargo specifically, just to see how the underlying business is operating. Now, looking at someone like State Street, $3 billion in revenue, $1.57 in EPS. So we actually have a slight year-over-year decrease in the top line, an increase in the earnings per share. So a bit of operational leverage going on here for State Street. Now looking at equity fund flows, guys, so this is all last week's data. We always get the lagging week's data. We never get the data as is. Now we saw $9.24 billion worth of inflows into equities. And this is what fund managers were buying. Very interesting stuff I want to point out. Fund managers were buying emerging market debt, municipals, high yield bonds, and then like bank loans, so like credit. In the equity space, they were buying technology, growth, and then Japanese stocks. At the same time, they were selling utilities, energy, financials, REITs, materials, and precious metals. So this could potentially signal a short-term top in precious metals and or commodities as a whole, because they have run up quite significantly in the last 2 to 3 months. And after last week's volatility, because we were down 0.96% for the week in the S&P 500, you think you'd see an uptick in utilities, energy, healthcare, and staples, but that is simply not the case. It looks like a lot of fund managers bought the dip both in growth names, tech names, Japanese names, and then high yield credit. And this still screams to me that fund managers, or both as private clients, are still risk on. Now, let's talk about small caps. Something very, very interesting we've seen in the Russell 2000 right here is that revisions to 2024 consensus earnings estimates have actually gone up for the Russell 2000. In aggregate, 8%. The median company has seen a 2% increase in earnings. Very, very good. If small caps do want to break out of that massive base they've been in for a while, they really do need to see the fundamental picture get better, because the technical picture for the whole market is good. So too is the macro. It's just the fundamentals that are keeping small caps hindered. At the same time, we've actually seen Nasdaq 100 NDX companies decrease their earnings, and maybe that's why the rally has stalled out a bit, because the Nasdaq 100 has pretty much gone nowhere for a month. It's been quite volatile to the upside and downside, but virtually it's gone nowhere. So over the next quarter and during this earnings season, if we see the Russell 2000 take the lead ahead of large caps, it shouldn't surprise anybody. Small caps are literally priced for negative growth, and any change to that narrative will see them re-rated by the market very quickly. Now let's actually talk about small caps versus large caps and forward returns. Small caps typically outperform 6 months after the first rate cut. So you can see here small versus large. So if this is going down, large caps outperform. If this is going up, small caps outperform. So you can see here that large caps outperform 12 months, 6 months, 3 months heading into a rate cut. Then we do have 1 month of outperformance here in smalls. And then we have a fairly even split between smalls and large caps. And then we tend to see small caps outperform 6 months, 12 months after. So it's best to probably, hold large caps into a rate cut. And then somewhere between 1 and 6 months after we get the first cut, look to adding small cap exposure, because they do tend to outperform significantly. And this is quite significant, 4% of outperformance above large caps. And large caps are no slouch. Investors love small caps because that's where they can find value, but where else can you find value? Now, looking at US sectors, if you do look at the aggregate PE of the S&P 500, you will actually see that the S&P 500 PE is trading at 21 times or just under 21 times. That's actually very expensive. But if you actually look at relative valuations, this is your Z-score right here. So it's essentially valuations relative to history. We can see comm services is mildly expensive to history, same with discretionary, and then technology is just blowing the top off everything. But almost every other sector is fairly cheap compared to their historical averages, and then some of them just outright cheap. Look at staples, energy, utilities, extremely cheap. And this is what happens in a risk-on environment. These defensive sectors tend to get very, very cheap. And if you can actually time a top in the market and get in at the right time of these, they can be exceptional trades for the most part, but they will lag the market in a risk-on environment. That being said, even stuff like financials, healthcare, and even industrials to a certain degree are undervalued, but I would say that industrials is probably more fairly valued than anything else. Now, looking at the broader market, we can also see that US large caps are very expensive relative to history, as well as US growth, and US growth is pretty much US large caps. But at the same time, US mid caps relatively cheap. Same here with small caps. Same here with US value. International developed markets, they tend to be very, very cheap. And then we have emerging markets, slightly cheap, closer to fair value more than anything. So there's definitely value to be had in the US right here, as well as international as well. So if you guys do go out and look, you can still find value, and not necessarily cheap because earnings are degrading, just growth at a reasonable price. And that's never a bad investment. Now, looking at money market funds, guys, we saw $70 billion worth of inflows last week, and we're sitting at about $6.1 trillion of cash on the sidelines. This is just retail funds. Private equity have about $2 trillion on the sidelines. So too do corporations. And there's a lot of cash sitting on the sidelines waiting to be deployed. And this also goes to show the strength of the overall consumer. What we're actually seeing is that people do have cash available, and it's not necessarily going to come out of the bond market or the stock market. They can just draw it from their money market funds. And we are actually seeing money go into money market funds week after week after week, which means there's still a lot of residual liquidity in the economy. Now, talking about the economy, this is something very, very interesting. This is part-time employed persons as a share of 16 plus year civilian employed people. So this is very interesting data. And I just got a note right here I'm going to read for you guys from BOFA. And they said, while the slowdown in full-time employment is not good news, it is important to note that people appear to be working part-time because they want to, not because they have to. And I think that just goes to show the strength of the economy. Now let's talk gamma. Now guys, I got a couple of BOFA institutional charts here for you guys. We look at these every single week because 78% of fund managers have access to BOFA institutional data. Now, we look at this chart pretty much every single week. The S&P 500 weekly chart with moving averages. We know we got the cup and handle. Measured move upside targets takes us to 5,200 where we are right now, 5,600, and then a longer term target of 6,150 to the upside right here with support in the 4,800, 4,700 range, and then at the very low end, 46, 4,500 range. So any pullbacks to here, very, very healthy. We can then go ahead and break higher levels, and even pullbacks to 4,600, again, still healthy. And then we can make our way to higher price action. Now, looking at another S&P 500 chart here from BOFA, I'm just going to read it directly for you guys. Market breadth as measured, the 10-day MA of new 52-week high minus new 52-week lows confirmed the rally into March, but has since developed a tactical march into April bearish divergence as new highs have waned relative to new lows. And essentially the 10-day moving average of new highs minus new lows confirmed the breakout here in March, but as such we've had a tactical bearish divergence into April, while the S&P 500 has kind of moved up and to the right. So this is a bit of a divergence right here, and it is a risk to the market. So what we do want to see is this probably move higher as the S&P 500 moves higher. Otherwise, this data would suggest that the S&P 500 needs to revert to its mean, and that probably means below the 5,000 level right here and right here. Another chart is the Russell 1000 growth relative to the Russell 1000 value. So growth versus value in the Russell 1000, and growth remains in a bullish trend relative to value if the prior high from 2020, 2021, and 2023 holds as support right here. This will be seen as a bullish breakout and retest relative to value and favors continued growth leadership. So we are testing these levels right here. If we do get below, that could be a bearish sign, and maybe we do hop into defensive names, maybe safe haven names, risk off, build some cash. If not, if it does hold, we do look to see continued growth leadership. And I do think that's going to continue, not before we do get a little bit of volatility, especially in an election year. Now, guys, this is some seasonal data, very interesting seasonal data that I managed to find on Twitter. And this is pretty much what happens when we have a negative April. Now, on a seasonality basis, April tends to be very, very positive. But when it is negative, these are the returns in the following months after a negative April. And we generally see a negative May, a negative June, a positive July, continued negativity here in August as well as September, when we then do see a lot of these losses pared in the months of October, November, December. So just something to watch. If we see more downside bearish action in April that could lead into May and June. We have a little bit of a relief rally here in July, and then we have quite the capitulation into September before we have the bulls come back into the market. But if you've made it up until here, thank you so much for watching. Guys, if you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.